All right, let's get right into it. We've all seen those headline-grabbing investment returns, right? 20, 30, maybe even 60%. But what if I told you that a nice, steady 15% return could actually be way, way better than that flashy 60%? It really all comes down to one of the most important questions in finance. Are the returns you're getting actually worth the risk you're taking?
So here's what we're going to cover. First, we'll look at why just chasing raw returns can be so dangerous. Then, we're going to unpack the actual Nobel Prize-winning formula that was designed to solve this exact problem. After that, we'll learn how to decode the score it gives you, expose some of its critical blind spots, because nothing's perfect, and finally, see how it paved the way for a whole new toolkit of smarter risk metrics.
Okay, let's kick things off with the core problem here. For the longest time, the investing world was obsessed with just one number, the final return. And look, I get it, it's easy to understand. But focusing only on that is a huge trap because it completely ignores the journey. And in investing, that journey, all the ups and downs, the volatility, that's everything.
To make this super clear, let me just ask you a question. You've got two choices on the table. Investment X, which returned a solid 40%, and investment Y, which returned a whopping 60%. Based on that alone, it seems like a no-brainer, right? But just hang on a second.
Now, let's add a crucial piece of information. To get that 60% return, investment Y was 16 times more volatile than investment X. Its journey was this gut-wrenching roller coaster of massive swings, while investment X was a much, much smoother ride. So which one is really better? All of a sudden, the answer isn't so clear, is it? And this is the exact dilemma the Sharpe ratio was invented to solve.
And that brings us to the man himself, the guy who gave us the solution, the American economist William F. Sharpe. What he did was give us a completely new, kind of revolutionary way to look at performance that honestly changed finance forever.
So back in 1966, Sharpe publishes this landmark paper where he introduces what he first called the reward-to-variability ratio. The idea was so powerful, so fundamental, that in 1990 it helped him win the Nobel Prize in Economic Sciences. The committee even called his work the backbone of financial economics. That's how big a deal this was.
And here's the core idea, the huge shift in thinking. Sharpe said that risk isn't just some abstract idea, it's a cost. Every single return you get comes at the price of having to endure volatility. His work, for the first time, gave us a way to actually measure if that price is worth paying.
So, in simple terms, the Sharpe ratio is just one single number that tells you how much reward, or, return, you're getting for each unit of risk you take on. It lets us compare totally different investments on a true apples-to-apples basis.
And this is it. This is the formula. Now don't worry, this isn't going to be a math test, but just understanding how it's built is the key to seeing why it's so brilliant. You see, the formula is actually beautiful in its simplicity. The top part, the numerator, that's your reward. It's your portfolio's return minus what you could have gotten from something totally risk-free, like a government bond. The bottom part, the denominator, that's the total volatility of your investment. So it's just reward divided by risk. That's it.
And that denominator, the risk part, is super important. It includes all types of risk. We're talking both the big market risk that affects everybody and the specific risk that's unique to a single company. The Sharpe ratio basically punishes you for any and all deviation from a smooth upward path. It's a tough grader.
Okay, so that's the theory. But what does this number actually tell us in the real world? Let's get into how to decode the score.
Think of it like a report card for your investment. A Sharpe ratio below 1 is generally considered kind of poor. You're just not getting enough bang for your buck. A ratio between 1 and 2, that's good. That's the target for most solid, well-run strategies. Anything above 2 is considered very good. And if you see something above 3, that is truly excellent and, frankly, pretty rare to see over the long haul.
So let's go back to our original puzzle. Investment X, with its smooth 40% return, has an absolutely incredible Sharpe ratio of 4.0. But investment Y, even with its massive 60% return, has a pretty poor ratio of just 0.5. The math is crystal clear. Investment X was by far the superior choice because it achieved its return with amazing efficiency.
But why? Why is that smoother ride so much better? Well, it all comes down to this really powerful concept called volatility drag. Because your returns compound on each other, big swings, and especially big losses, act like a mathematical penalty that makes it way harder to grow your wealth over time.
And just look at how destructive that penalty can be. If you lose 10%, you only need about an 11% gain to get back to where you started. No big deal. But if you lose 50%, You need a 100% gain. You have to literally double your money just to break even. That is the brutal, unforgiving math of volatility.
So here's the absolute key takeaway. You should think of volatility as a tax on your compound interest. The more volatile your investment, the higher the tax you're paying, and the less of your actual returns you get to keep and compound over the long run.
Now, the Sharpe Ratio is an incredible tool for sure, but it is not perfect. Like any hero, it has an Achilles heel, and understanding its blind spots is just as important as knowing how to use it in the first place.
So here are the main criticisms. The ratio kind of assumes that returns fit neatly into a bell curve, where crazy events are almost impossible. But we all know real markets have what are called fat tails. Crashes happen way more often than that model predicts. It also gets artificially boosted by assets you can't sell easily, and, get this, it even penalizes you for good volatility, like a sudden massive gain.
This number right here, this is the ultimate cautionary tale. This is the jaw-dropping Sharpe ratio of the infamous hedge fund long-term capital management. An unbelievable 4.35, right before it completely imploded in 1998 and nearly took the entire global financial system down with it.
The strategy LTCM was running is a perfect example of this old saying. They were picking up nickels in front of a steamroller. They were generating this steady stream of small, consistent profits, which made their Sharpe ratio look absolutely amazing. But they were doing it by taking on a hidden, rare, but totally catastrophic risk that eventually ran them right over.
But the flaws in the Sharpe ratio didn't kill the idea. In fact, they did the opposite. They inspired an evolution. This led to a whole toolkit of more specialized metrics, each one designed to fix one of the original specific weaknesses.
And each of these alternatives just refines that definition of risk. For example, the Sortino ratio only penalizes you for downside volatility, the bad kind. The Treynor ratio measures your return against only market risk. The information ratio measures a manager's skill against a specific benchmark. But they all owe their existence to Sharpe's original, powerful, game-changing idea.
So what the Sharpe ratio really did was transform investing from just a simple game of chasing high scores into a disciplined hunt for efficiency. It forces all of us to look past the flashy headlines and ask the single most important question of all. Now that you know the score, you have to ask yourself, how much risk are you really taking to get your returns?